Good evening to all of you. Welcome you to today's webinar. Today we are looking at the factors which are impacting the indices, stocks, and also we are going to look at which are the sectors in which you can invest, either in the cash market or in mutual funds if there is going to be sectoral funds. So that is for investment purposes concerned. Because the reason why we took this topic is, now we have seen the last couple of days huge volatility. Ever since budget period of from start last month, exactly on the same day, February 1st, the market has been very volatile. Let's look at first the graph, which will give you an understanding of how the market behavior was in the last 1 month. So on this was the budget day, that is 1st February. On the single day, it was rose something like 700 points, or rose 5%. Then it went straight up to 15,431. Then from 15,431, there was a fall within 5-6 days to 14,635, 800 points. Then a single day here, if you see, compared to the previous day, this is 14,982, and the previous day was 14,707, almost a 300 points rise. Then from this day of 15,100, it fell down to 14,529, almost something like a 400-500 points of crash. Huge swings, and today it was an inside day pattern, and the market went up to 14,806, and compared to the previous day low, just closes 15,529, again a 270 points rally from there, 280 points. So there's been a huge swing that has been taking place in this market. And normally in bull markets, generally, it doesn't happen. Generally, it's a pattern like this. It generally keeps going up, but goes up in a very steady manner for some days. Similarly, see here, it's like this. And these days, the corrections are short-lived and quite steep. Now, we have seen also previously that if there is such a gap, so this is a gap, right? So compared to the previous day close, 15,097. This is a gap down, right? This is a great opportunity to go long. That's what we said last week, because we have seen that such gaps, particularly in a bull market, are closed within 20 days. And it did not wait for 20 days. It may be even within 3, 4, 5 days. So, generally speaking, that we expect that before the March, we should see this particular close being broken. Who knows? Probably it can even take off this particular thing and go towards 15,450 or 15,500 levels also. So a possibility of a big rally is still possible in this particular case, and hopefully that should materialize for bulls. Okay. Now, what has been driving this market in the last 1 month from the fundamental point of view? Last week we saw the technical factors and also the way we should look towards the investment or even for trading purposes. But first of all, the bigger picture should be understood so that you will trade with confidence. One for investor, and second for traders who are looking at doing option trade instead of futures trade, because nowadays the futures margin has become quite expensive. So you put money for the option, so you would like to know whether you can just roll over the option position at every lower level, whether you can keep rolling that position, particular positions, so that you may be in a position to make some profit as and when it goes up. So probably you may be looking at that point of from that point of view also. So from all those perspective, now we should see what were the factors which have been impacting the market for the last 1 month, and whether those factors will continue to dictate, or are we going to see something else. Now, of course, we know that everything is quite dynamic. Whatever happens in life itself is dynamic. Whatever we say need not hold true in future months. If that be the case, then prediction becomes easier, right? So there are always a lot of variables which keep suddenly cropping up. So when we try to understand the old variables, new variables keep cropping up. Okay, so which keeps impacting the market either on the positive side or on the negative side. In a way, this is also called as a noise. In the sense is, in the long-term pattern of a market going up, there are always some crisis which keeps pulling the market down. Okay, And those crises can be labeled as minor issues, or it could be major issues. Now, whatever that happens, whenever the correction of a magnitude of more than, say, approximately 20% happens, then I think the crisis is slightly should be accepted as bigger one. That is, if the index is going to fall by more than 20%, generally speaking, then there is some major problem which is hurting the economic prospects. We have seen this in the last one decade 2 or 3 times. One is in 2009 Lehman collapse. It was a major impact. Then what happened last year in February, March has been the other major issue. In between, due to some internal issues regarding some budget taxation, market had fallen by more than 20%, but it was close to 25%, and then it just recovered. Okay. So the last 10 years or so, there have been 4 occasions when the market had fallen by more than 20%. So more than 20%. And in 2 occasions, it was short-lived, just below 20%. And only in 2 occasions did the market fall by 35 to 40%. And in the case of 2009, it was much more, because it fell from 6,000 to 2,000, meaning 65% fall was there. Only 35% it was lift. This time the fall was more or less around 35%. But if we take in the absolute number value, this time the fall was something like 4,900 points or so. That time also the fall was 4,200, 4,300 points. So in absolute numbers, the number is fall in Nifty is around 4,200 to 4,500 points. And in percentage wise, this time it has been much lower, 35%. And the previous fall during Lehman collapse was around 65%. So the factors that were affecting the markets are now being known. I think the old factors are very well known. The recent pandemic has been one where probably there was a first feeling that economies are going to be shut for a very long period of time. The world is going to face a huge problem, and nobody was certain about how deep the problem is going to happen. But after a month or so, it just started to recognize that problem is there, but it can be overcome. In terms of the fatality, the coronavirus fatality has been quite low compared to the previous infection cycles. And so that gave some confidence to the market. Second was the unprecedented responses which came from governments and central banks. Central banks pumped huge amount of liquidity, lowered interest rates. Governments across gave a lot of fiscal stimulus. And because of that, the money first flowed to the market, then to other various parts of the economy. And luckily, when the economy started opening after 3-4 months of shutdown, the demand did not take much of a time for the demand to come back. So the resilience of the general public at large probably helped the economic recovery to take place soon, because they were not they have not gone into any big fear psychosis where probably they were into a shell. So they were willing to come out, and so things also changed quite for the happy situation. And now we have seen the last quarter GDP, that is the October, November, December quarter, has come into positive territory, and we can expect further climb in the economic recovery in the present quarter. And because of that, we have seen GST collections also going up. So these are quite positive signs for the economy, and it is expected that probably next year the growth will be upward of 10 to 11%. So the markets continuously try to revise its earnings growth, and hence the climb in the market to some extent keeps reflecting of what is likely to happen in forward months, because the trading is very well known. The market looks more at the forward earnings, and because of low interest rates and abundant amount of liquidity, demand now, which was just subdued, probably looks like coming back because of all the indications that we have. Also the agricultural sector, where there has been a very good growth. These factors have been helping the Indian markets to go up. So that is on a broader side over a period of last few months, and it just got accelerated. And there was always fears when the market has come to a certain such big stage, always fear that whether it is on an extended valuation and whether it will fall. But what happened after the budget? See, before the budget, there were certain sectors, particularly one sector that was not doing well is the banking sector. So what changed the complexion after the budget was the banking sector. Now, if you look at this one, because it is also important to know which sectors we should be in coming time. Banking sector. So if we divide it into macro, that is what the government policies have been, and also the earnings or by big PSU banks as well as private sector banks. On the macro side, the government has shown its commitment to help the banks, one, through creating a new asset management company which will take off the NPAs of the banks and then will manage those NPAs. So basically it will look as if the banks are getting rid of their NPA positions and they can concentrate more on their core activity, and the NPAs will be looked after by somebody else. So to that extent it eases the burden on them. One. Second thing is the NPA cycle itself probably has turned around for most of the banks, particularly for the public sector banks. But the NPAs, the slippage has started to go down. That was reflected quite in the case of SBI result. And that's why we have seen SBI, which has never traded above 350, broke and came to around 400 levels. So a very clear thing that is happening in the market is the public sector banks are now being looking much better than what it was before the budget. Private sector banks were anyway doing well, and now with government's thrust on privatization, because the budget also has talked about privatization, asset monetization, and involvement of private banks also more in government related transactions, that has also given a fillip to the private sector banks. Now, of course, the privatization of public sector banks may happen over a period of time, and that sentiment also has helped it to come up. And then whatever the RBI policies which are in terms of the accounting practices and other things related to the banking sector has also helped. So the banking sector, which constitutes 35% of Nifty, is one of the major, because you've got a lot of financial NBFC stocks, you've got PSU banks, you've got private sector banks. So you've got, say, major SBI, you've got then all private sector, HDFC Bank, then you've got ICICI, Kotak. So all these banks are there, and you've got Bajaj Financial Services. So a lot of banks are there, and banking. Then of course housing sector like HDFC. So there are a lot of stocks, heavyweight stocks with a considerable amount of weightage. And after the last quarter earnings result, most of the brokerage houses have enhanced the targets for most of the private sector banks. Now, most of the brokerages are talking about ICICI going to 950 to 1050 from the 650 levels. Considerable amount of upside potential is being given to still for the private sector banks. So is the case even now for SBI. So it looks as if that even if the overall market was quite expensive, the market potential to a very large extent was buttressed by poor results from public sector banks till now. Now, with the likely earnings expansion that can come from public sector banks, the privatization, asset management company construction, and also good results coming on from private sector banks, the targets are being revised in the upside, which means that if these are going to achieve these targets over a period of say 12 months or so from now, if say ICICI Bank is going to go from 650 to 950, which is almost a 50% of this, so then some of the private sector banks also follow that, then 30-35% of that is able to get around 35-40% itself, which means the Nifty will get an advantage of 10%, at least because of the 30-35% on that. So that is one thing where probably the Nifty can look towards making a major gain. Now, the other important sectors which have started to do well because of the global that is the one, there is a commodity cycle. Now, if you look at the commodity cycle has turned upwards, And in the last 1 month, we have seen the zoom in copper, steel prices, of course, oil. All these things have shot up very considerably in the last 1 month. Now, there are companies which are both in the Nifty as well as otherwise, where you got the metal stocks. Okay. Now, prominent stocks, of course, Tata Steel. Then you got the Hindalco. On the commodity cycle, of course. Other than that, then you got the Vedanta, which is not there right now. There, so Vedanta is there. Then Hindustan Zinc. So many other companies. So these are commodity companies. Now, because of the construction sector also having started doing well, we have got the cement where the prices have firmed up, and you have got say Shree Cement in the Nifty. Then you have got Grasim, which has started to do well. So this is the commodity cycle sector has also started. So banking and commodity stocks, you can say, are really on a fire right now. Besides that, some individual stocks, other stocks which are getting the benefit, for example, auto. Now there are policies which have been announced, scrapping policies. Auto sector, because of the rural demand going up. So these things really are helping the auto sector. But what has been affecting this is the rise in commodity prices. But some of the companies have been able to pass on the price effect to the end consumer. So to that extent, auto companies, you've got a lot of companies, Hero Motors, Eicher, Bajaj, Maruti, Tata Motors. So these are the companies which are also doing respectively well. Now, the other two companies which are very diversified and has a good this one, Reliance Industries, L&T. This is a benefit of capex cycle. Now the government of India is now concentrating more on putting money in infrastructure. So the government expenditure is being increased on public sector public infrastructure projects. So this is helping construction companies particularly. So L&T. Then you got the housing side, where a lot of benefits already flow, HDFC. Then Reliance Industries Limited on its own, because of its own ability for the telecom side, retail side, for its expansion into various areas. Reliance Industries is always a favored stock, which is also, after a recent correction, now has started to move up. Now the other two important sectors were probably IT. It did extremely well last year. It did extremely well last year. It may do well, but probably this could be a little bit subdued because of its wonderful performance last year. There is a chance that probably IT could be a little bit subdued. Not that it will not grow, but IT could be a little bit subdued. FMCG could be subdued. So these are the two sectors, particularly out of which FMCG could be a little more subdued. So the IT could be subdued, but still possibility of a decent rise is still possible. But one thing is about IT sector is that generally it is immune from policy decisions by the government. So that much of volatility is not expected. So I think probably it's more stable climb or decent fall. And another good thing about IT is that when markets collapse, if at all collapse for some reason, IT sector and FMCG are a little more defensive stocks. So there is always a possibility of a shift happening to IT sector. Even last time, the markets, when generally indices collapsed by more than say 35-40%, a lot of IT sectors, probably the fall was limited to the extent of 20-25%. So it definitely outperformed in terms of the fall in compared to Nifty. So to that extent, IT is always a safe bet, with earnings also likely to grow. See what happens as far as IT is concerned, there is always a vertical rally just starting 15 days before the results. Now, let us say for the January, February, March quarter, results will come in April, right? So probably if you see by March end, April first week, you can see the IT stocks again climbing up. And then after the result is announced, it will generally fall and consolidate before the next rise happens. So this has been the general pattern as far as IT sector is concerned. So if you are looking at trying to get an outperformance when even in compared to Nifty in the coming months, then in that case, I would say that probably no, we should be looking more towards banking. This will be the first preference. Commodity, it's a very difficult thing. Suddenly, it can have a collapse. So I'm not going to give much of a preference as commodity is concerned. Banking definitely, and then the next still definitely I would prefer IT. Okay, always. So these are the two probably can give you a return which could be slightly better than Nifty also. Okay, but we have already explained last time also that generally Nifty ETF itself does much better. So you don't need to do SIP of Nifty ETF, it can still do better. But if you are looking at trying to see whether some other sectorally, whether some stocks can do better than Nifty, so that you want to have a much higher gain this time, then you should look towards banking sector. Probably then look towards IT. So if you are looking at probably in the banking sector, because generally if ICICI rallies by 25-30% this year, I'm sure that banking sector as a whole will give you also a very good return. So I would suggest that if you're looking at some sort of money to be put in, of course the banking sector ETF can also do much wonderfully well, I think, in coming months. So that could be a first preference. IT, commodity cycle, you have to be careful about it. It's still going to be hot probably, because of the likely global, because of the faster global economic recovery which is expected in coming months, both in US, Europe, as well as in India, because of the fast-paced economic growth that is likely. Commodity cycle may this one, but probably anticipating that already copper and other commodities have moved up very significantly. Chances of cooling can happen, because we have seen also in gold rallied, and then you just try to get near the top because it's climbing, then it falls and then it consolidates at lower level. So commodity probably gives me that fear, but not as far as banking and IT, because commodity has to be just analyzed from the way the commodity price trends are. Okay, but banking and IT, I think these are all the banking is a more of a structural change that is happening in India, and banking sector is well placed in that sense. And IT is an evergreen thing, which is immune from all these things. So that is going to be another preferred one. Now, if we look at, as I said, the economic variables keep varying, and so it is not easy to talk about what all can happen in coming months. But you need to have some conviction, as to when the fall was taking place yesterday. Okay, and it is right now in this position. Is it an investable place or is it not an investable place? Now, there are different ways of analysis, but suppose if you go purely by technical thing, the problem is that whatever pattern which you are following for identification of the trend probably will get you at a slightly higher levels, right? So at a higher level. Suppose it has fallen to 14,500, you will be a buyer only above 15,000 because of the huge volatility that is taking place in the market. So whenever the fall happens, you should get convinced that it is worthwhile to invest. So on Friday when it was falling, probably you could have waited to see what's happening. And today it was around 14,700 for some time. For a long time it was around 14,700. It's a good place to go for a long. It's a good place to go for a long, okay, over a period of time. So whether you are a trader or whether you are an investor, you should be in a position to strategize. That is very, very important. Now, what triggered the fall in the last couple of days, and probably what probably can happen, let's say. Now, normally markets, we have already explained previously also, that markets don't like higher interest rates. Markets want always a lower, markets go up when the interest rates are low. This is what happened during this pandemic time. Markets, one of the reasons for the rise is lower interest rate, because you don't have much of an avenue, right? So probably because of lower interest rate, you say, what may I get in 5 and 6%, so let me try take the risk. A higher interest rate scenario is generally not a welcome measure. But it is not a really higher interest rate in the sense of the higher interest rate. I think probably that is a bit of an exaggeration, whether the short-term interest rates have gone up. But it is not going to make any difference for people like us, because we are, if at all we are investing in short-term fixed deposits offered by banks, where there is not going to be much of a change. But where it happens is, it happens in government yields. now a 10-year yield, 5-year yield. So these things move up according to the future inflation expectation of the market. Okay. Now, if you see the Indian yield, which was around 5.85% sometime back, went up to 6.25%. This is a 10-year yield. So this is a huge movement, and this has come primarily because government is borrowing more in order to fund its fiscal stimulus program. Because of the pandemic, the government had to announce various stops, and also they have to announce a lot of measures in order to ensure the growth comes back quite fast and the economy expands. So all those things had to be funded without raising the taxes. So what do? They go for a borrowing. So when they borrow, they have to, RBI does the management for the banks and so for the government, and so they float papers on behalf of the government of India. And so since a lot of papers available, then in that case, the demand for the papers go down. That means it pushes the yields up. So that is what has happened. Now the percentage has gone up from 5.85 to 6.25% in a short period of time. In US also, if you see the yield which was less than 1%, 10-year yield, went up to 1.6% last week on Thursday, Friday. And this is what spooked the market. A higher yield suddenly when it goes up, now what happens is those who have invested in the bonds, okay, the bond prices fall because when the yields go up, it's an inverse ratio, and the bond prices fall. And when the bond prices fall to this extent, from less than 1% to 1.6%, a 10-year yield, a 0.6% could probably translate into a much higher percentage of loss as far as the investment is concerned. Probably it could translate within a short period of time in a bond market. The loss, which is 1 to 1.6%, okay, it means what? On a percentage basis, percentage less than 1 to 1.6. If it is 0.8 and it is moved to 1.6, it's almost a 50%. Like 50% jump in the yield. A 50% jump in the yield probably could just wash out because there can be huge amount of losses that will be made. If you look at what was the bond price some time back and what is the bond price right now. So what happens is it sets off a chain reaction because asset markets are closely interlinked. Okay. So because a big investor does not invest only in equity or gold. The investment is there in bonds, in corporate bonds, government bonds, equities, commodities, everywhere. Okay, so when one sector is badly hit, probably they try to take profit in other sector. So that causes the equity markets have been generally going up, and so in order to fund a part of the losses which they might have been making in bonds, it leads to a selling off in equity market because nothing changes within overnight as far as the fundamentals of the economy is concerned, because that has not changed in the last 1 week because generally the infections are coming down and vaccination is in progress. More vaccines are being approved, stimulus programs are being approved. So with that, there is no reason for any pessimistic scenario as far as the growth is concerned. So this is purely coming from a technical point of somebody making, because of the bond yields going up, inflation expectation going up, and probably an higher interest rate at some stage can probably derail the market bullish momentum. But that was despite the assurance coming from central bankers saying that there is going to be no premature exit from the market, which means that the low interest rates will be there for nearly next 2 years, even if the economic recovery is going to take place. Liquidity will be in abundance. All these things have been assured. I think the market participants are also aware that probably even if the inflation is to come up to some extent, the central banks will not will hesitate to move from lower interest rates that easily. So not that it's not that they are not aware of that. It is definitely, if I and you can guess that probably this could be the situation. Big investors also will be quite confident of what probably the belief that they have and what the central bankers say. So you can adduce this only for a technical reason. Technical reason being a loss happening in some other market pilfers over to some other market. Now when it spills over to some other market, then immediately when most of the trading right now has gone into the hands of computer systems, algo trading. So losses keep coming because some levels are being broken. Then you see some huge amount of selling that takes place. Similarly, some levels are being broken on the upside. You see huge amount of profit coming also. So I think there is a two-way volatile movement in a situation like this. So if we see through this, then in that case you will get a confidence that no, these are some random noises which are coming in the market for the time being. And once this issue fades out of the market, probably this reason which has impacted the market negatively will not be there. For a long time we talked about pandemic. Now pandemic and now nobody talks about it as far as impact on market is concerned. Now similarly we have spoken about something less issues which have impacted the market for a shorter period of time. Probably the stimulus package and all. So everything has a cycle. Everything has a short shelf period, these things. So right now, whatever that happened, the spike in the bond yield, we have to analyze from the overall thing whether this will happen. Now, this is unlikely to happen because banks may not, central banks will not probably tolerate such a high yield because that will derail the road. So if that be the case, then you are very sure that probably it will all stabilize. So when the stability comes back, the inflow comes back. See, there is a pattern between FII and domestic institutional investment here. Whenever the FII puts in market, you can see DI outflow. That is here, opposite signs will be there. If FII invests, DI negative. If FII pulls out, DI positive. These things happen. But FII predominantly put money in blue chips, index stocks. So that's why you see, whenever the FII investment comes, the equity indices move much sharply higher, even if the amount is not much. Even if DI investment is more, then probably you will not see the broad index going up significantly because the DI investment will be widespread. Okay, domestic institutional investment will be widespread across various sectors and stocks. FI investment will be more concentrated on top stocks, blue chip stocks, index stocks. So that has the capability to revive the market very fast. Even a few thousands of crores can keep the market in a buoyant mood. So on Friday, there was a big pullout that took place from the FI side. Approximately 10 to 12,000 crores combined cash and FN futures and options were sold by FIS. Okay. So this 12,000 crores, which also happened in a single day, can easily come back in case if the yields start to stabilize. So if we have the conviction that the yield spike is going to be a temporary phenomenon, and if you are convinced, then this is a place where you have to see through that noise and invest. Now, investment is a little easier because you know that if your view goes wrong and if the market is going to fall lower, then probably you will have some more money to back it up by buying because then you can average it out, and that is a much more because for an investor, I think you should be happy on both sides. If you have already invested, the market goes up, you are going to make a return. Okay, fine. If the market falls after you have invested, then you are getting another better chance for you to invest again to average it out to some extent. So because you are not going to average everything at one go level, right? So for those who have that sort of resources, I think the fall or the rise should not matter because in both ways you are going to make it be in a happy situation. But as far as the trading is concerned, I think the approach to trading, the difference that while you make money definitely by investing over a longer period of time, there is always a pattern that probably a lot of traders lose money. Okay, so what is the difference that it makes? The question is the approach to the market, the psychology of the participant. I think these are the most important determinants which shapes up the victory or defeat in the market. An investor is a passive and probably you say a gullible investor or a very innocent investor or not an informed investor. Even if he has just invested in some blue chip mutual fund, he would have made money. But even a well-informed good trader might have lost money. Why? Because he has a confidence that I have invested, it will grow, and he doesn't even care and he makes the money. The other person, because he has either over-invested or getting confused over the market direction movement, shifts his position leg up and down or whatever it does. And because of the psychology of preventing him from taking a new position after he makes a loss, all these things combine and pull him down. So if you are a trader, then in that case, your trading approach can it be almost like an investor. So whether you can jump your psychological thing like an investor. Okay, if that be the case, then in that case you are also going to be quite successful. Okay, so those things should be kept in mind regarding the aspects of a trader and between the aspects of investor and trader. Now, an investor, when he understands the overall situation which is prevailing in the market presently, then he is able to see through and then he will go for a buy. Now, we decided that these things are going to be temporary. The last couple of this entire month has been affected by the following reasons. One is budget movement volatility, then again government announcements favoring private sector participations, so that is also playing a part. Then the yield spike. Okay, so these are all. So now these are all known factors. Nobody is going to, though the budget is good, nobody is going to give this reason after a month or so, right? Okay, that anyway, that is going to be reflected in future economic growth and corporate earnings. So it has to translate into that. Now the yield spike, it could be temporary. It could keep coming, going up and down, all those things. So finally, for the market, what will happen is that it will be purely driven by earnings growth. So all the other things are going to be quite temporary in nature, earnings growth. But the chances is that for a normal investor like us to make an assessment that earnings growth will be so much, it's not that easy. It's not that easy. So we have to read a lot to get the confidence. So there will be a lot of research reports which are available. And based on the research reports, you have to make because if a lot of brokerage houses say after the thing that no, ICICI is going to be 950. Okay, somebody says 950, somebody says 1050. So let us say you take even the minimum base case and look at where it is presently. So similarly for other stocks, look at all those things. Then look at that sector's composition as in the index is concerned. If this is going to rally by 40-50% from the present level over a period of 1 year, and that composition has got 30%, 35% in that, then you should give straight away 15% for the Nifty rise. And all the other sectors, even if it contributes a little bit here and there, because we have seen IT still will have a good earnings growth only. So that is another thing which will do decently well. Companies like Reliance and L&T will do well. So all these things will constitute 60-70% of the index. All could be contributing to somewhat upward growth. Then the index has to do well. So all these things gives us a confidence that probably the market can head itself a little more higher. And so any correction is something which should be welcomed and it should be bought. So this is the broad sense of the market. But suppose always you will also think that these are known factors. What could be the unknown factors? Okay, and it's very difficult to look at. It could be suddenly some border issues come. Okay, so that could be temporary, even if it is for a few days. There can be some issues which could be temporary and it could hit the market. Only the long-term thing can have a problem. See, this time during pandemic when the market was crashing, it definitely raised doubts. When will we get those levels back? When we was crashing down from 12,450 Nifty to 7,500, one could not even dream that within that particular year itself 12,450 could be crossed. Okay, so it was not known. The only thing that you can be sure is some stage the index will cross 12,500, and let me keep averaging it out, and whatever comes we will see. If that must be the case of an investor, that should have been the case of a trader also. So that is I am talking about for a positional trader. Now when you are looking at your thing as far as a day trader is concerned, I think none of this will matter. None of this will matter because then you will have to just look at what are the levels. We have seen so many times. What are the some techniques which you use for intraday techniques? You have to employ some of those techniques to do an intraday trade. Okay, but you are doing an intraday trade, so probably you would like to carry your position on some day. Then these things can be on your mind when you take the overall position. Then just roll over the position. Okay, all said and done, there will always be risk. So the risk mitigation is a very important part, for which the strategy becomes. So one is the opinion and second is the strategy. Now the opinion is based on whatever that we have been talking about it. The strategy will be to take care that in case if the opinion goes wrong, okay, whether a strategy. Now some other strategies, okay, if it falls after I invest, I will average it out. That is one strategy. Second thing, if it is fall, then it should be a stop loss, but stop losses are difficult to put in futures. I will go for an option. These are strategies, and in this option I'll do like this, I'll structure the option like this. Third thing is how much of money, how can I rationalize it for a higher return on the money that I'm putting. These are strategies. So first make your opinion, then look at your strategy. Okay. So all these things are important from the point of view of investment. I told you last time itself that Nifty ETF itself on an SIP is something which probably will give you a good return. But in case if you want to, based on expected growth, much higher thing than in banking sector, you can also look at some banking fund as an SIP scheme, okay, or on a fall take some lump sum amount. As far as the banking sector is concerned, IT sector will continue to be in flavor with the result period, and after that a consolidation, which I told you. Commodity cycle still probably is not, it is up, but probably the huge surge that has caused is just reminiscent of what happened as far as gold is concerned. So after that, when the fall took place in gold, it just started to only consolidate and didn't move up, and after that there is a slightly greater fall. So whether some of the other commodities will suffer that same fate, very difficult to say. So safer right now looks to be Nifty, Bank Nifty, and IT sector. So within that you can look towards some individual stocks as well. So this is what we thought probably will bring to your highlights, that don't know the situation which is prevailing right now, the factors which are prevailing both locally and globally. And we will also look at a little more carefully about what an expanded thing as far as the commodity cycle is concerned, because today we have spoken about generally we have spoken about the equity side. Of course, we have mixed the commodities also to some extent. We will look at commodities also in coming days. So right now time is 7:40, so you can ask your questions now. Thank you very much.